It's going to be all about the FOMC will they, won't they policy setting meeting this week. But that meeting doesn't start until Wednesday. So with me down the line to discuss all of the week's potential talking points is Jan Randolph. Jan, the week kicks off with the markets digesting the weekend China data, whereby industrial output rose by a less than expected 6.1% year on year, while fixed asset investment rose at the slowest pace since 2000. China's stock market has also taken another dive, but what does this all say to you about the Chinese economy, present and moving forward?
Well, in short, we are seeing a slowdown in the Chinese economy. Different ways you can take a pulse of an economy. GDP, industrial production, but the stock market's probably the least valuable in what it says about the China slowdown. There's so much excess savings and liquidity in that market. It's more of a casino than what it actually says about real underlying corporate performance and economic performance. But yes, there's definitely a slowdown happening. The official figures will be below 7% next year. I think we can take 1 or 2% off that for a real take on the economy. But it will probably trough next year rather than this year.
Last week, the Central Bank of Russia appeared to give in to oil and held rates, highlighting concerns about the recent weakness of the ruble and the impact this will have on inflation. Now, EM and general currencies are under downward pressure as commodities take another leg down. When will these trends stabilise, Jan?
Yeah, I think they're all connected. The currency weaknesses in the emerging markets, the commodity price falls, and the China slowdown, they're obviously all connected. But it's important to put the horse before the cart. The cause really here is China's slowdown. That's still the biggest risk story out there. It is driving the weakness in commodity markets, taking the wind out of the sail of oil prices yet again. But also weaknesses in emerging market growth because of slowdown in China as an export market. So we're seeing this generalized weakness, and it does all point to where China's going. So if we ask where the ruble's going or where oil is going, we really have to ask first where the Chinese economy is going.
An ongoing issue is the migrant crisis, with today seeing Germany closing its border with Austria, essentially Schengen suspended. But Jan, to your mind, what are the true economic costs and benefits of the refugee crisis in Europe?
Yeah, it's interesting because obviously this is immediately a politicized issue, and it's rightfully in the minds of politicians and the wider population. And what first comes to mind are the costs of keeping people safe, the additional pressures on public services, healthcare, education, and what this could mean in terms of budgets. And it's fine that we can calculate the cost, the immediate costs, and there will be. For example, in Germany, it's estimated that it will take up 6 billion euros, but they've got a budget surplus of 20 billion, so the Germans can certainly easily afford it. How they manage it is quite interesting. I think if they manage the integration properly, 2/3 of these migrant refugees, particularly from Syria, are deemed to be employable, and they are educated. Many of them are middle classes, and they should be more easily integrated, and that will deliver longer-term benefit, particularly for Germany, where we see a declining population, an aging population. Even without refugees or migration, Germany faces a net deficit of its workforce of 1.8 million by 2020. So the refugees will go some way to counteracting that, but not fully.
Indeed, markets are playing a waiting game for the Fed's rate decision on Thursday. What do you make of the suggestion an earlier move was warranted, and that by leaving rates too low for too long, the Fed have inadvertently found themselves boxed in and at the mercy of external economic and financial shocks? And will we see liftoff this week?
Yeah, this is a classic argument. The fundamental rub is if interest rates do need to go up at some point, in other words, back to normal, and because that is what the interest rates are ultimately there for, to cool an economy as it begins to overheat. But we're not really seeing overheating economies yet, and the signal there really is inflation. Inflation is so subdued, and the normal reason why central banks raise interest rates is not really there yet. it has to take note of what happens abroad. Ultimately, it will do a diagnostic of its own economy, the strength of the labour market, income growth, the strength of the overall economy in the US. It will take the cue from there. But there will be this kickback from overseas, from China, from commodities, and they may want to wait a little bit longer, wait to see whether these effects wash out first before actually going ahead and make a decision. I think it'll be more towards the end of this year rather than this week.
Jan, thank you. Viewers, the TV team will be covering all the events discussed and more, so please do keep clicking back. Goodbye.